Trump tariffs or trying to take advantage of arbitrage. And the possibilities, whether it be gold revaluation, whether it be blowing up the banks in London who Gordon Brown sold almost all of their gold, so you revalue the price of gold, well, it ain't going to benefit. We're at a place right now where desperate times call for desperate measures. We have $28 trillion in US Treasuries that are due in 3 years, Dunnigan. In 3 years, it's $28 trillion to get the tax revenue will be under $15 trillion. And so you take all that tax revenue over the next 3 years, even call it $5 trillion a year, which is under that now, and he wants to lower taxes, but give him the benefit of the doubt. $15 trillion, even cut some spending and all that stuff. We owe $28 trillion. So we're halfway there, and that doesn't account of all the debt we accumulate over the next 3 years. We're already at over $800 billion in debt for this year, and it's only February.
Trump's tariffs and strategies to exploit arbitrage opportunities, whether through a gold revaluation or destabilizing London's gold reserves, aim to benefit U.S. interests in a desperate fiscal situation. There's a huge fiscal gap, with $28 trillion in U.S. Treasuries maturing in 3 years and expected tax revenues falling well short, around $15 trillion over the same period. This shortfall, combined with the rapid accumulation of debt, already $800 billion this year, highlights the extreme financial pressures and the need for drastic measures. AndySchectman, a seasoned financial analyst and market commentator, explains that the recent regulatory changes now require dealers to report only those silver coin buybacks sufficient to cover COMEX contract deliveries, leaving smaller transactions unreported. This change highlights broader market issues. While silver remains historically undervalued and the gold-to-silver ratio is off, massive amounts of capital rush to acquire physical metal, even as the public remains largely unaware. The unraveling of a decades-long rehypothecation scheme for gold and silver is becoming evident. With investors like Warren Buffett holding enormous cash reserves, there's a growing sense of caution. Rumors suggest that Trump might be targeting London's fractional gold system to disrupt U.S. banks, although these remain unverified. Additionally, a noticeable divergence between paper and physical gold prices, from an $82 gap down to about $30 to $35, points to delivery stress and possible arbitrage opportunities, though global shipping costs likely limit that incentive. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
To what you were just saying, they changed the law recently on reportability, dealer reportability on buyback of junk silver. Dimes, quarters, and half dollars used to be reported my whole career if you sold back 1,000 face or more. Not anymore. It has to be sufficient enough to be able to cover or to satisfy delivery on a COMEX contract. Junk silver does not qualify like a kilo of silver bar would, or 100-ounce silver bar, or 1,000-ounce silver bar. And so they pulled it out of reportability in terms of requirements by the dealer. None of this takes away the client's obligation to do the reporting. It just means we won't do it on their behalf. And, you know, that's another example. Not only is silver, you know, historically undervalued, not only is the gold to silver ratio historically out of whack, following the same thing I've just been saying. But these things are happening at a time when the biggest money in the world is rushing and scrambling to acquire physical metal and hold it themselves. I mean, and yet the public is asleep. I've never seen an environment like this ever. The things that are happening on COMEX and the LBMA, it's unbelievable. And it's almost as if this giant Ponzi scheme of rehypothecated gold and silver is coming to an end. And that's what's, you know, interesting. At the same time, you got Warren Buffett, who's sitting on, you know, $334 billion in cash. He has right now $286.5 billion of short-term treasuries. That's 91 billion more than the Federal Reserve has. And this is the greatest value investor of all time, who has no interest in holding securities. I mean, he owns some still, but it shows you his mentality. Everyone is flocking at the Trump trade, and you have the most legendary investor of all time having more cash than just about half of in fact, more cash than all, but in terms of market cap, His cash balance is larger than the market cap of all but 30 public companies in the world. What does he see? And why are we seeing such a massive drive to accumulate metal? And it's interesting too, because I asked AI, just for those people who haven't heard this, I asked AI, because everyone's saying, well, there's a whole new thread out there, that we didn't talk about, done again last week, about what I thought this gold coming back was for. And there are people like Tom Luongo who will tell you this is being done to blow up the Bank of England. I'm not saying I believe that or not. It's intriguing that Trump is angry that he found out it was the aristocrats in England that were behind all of these problems with him, with the election, and that he's trying to get back at them by exposing this fractional system in London. And the rumor is that the US banks in London are now long. I can't substantiate any of this, okay? I don't mean to spread innuendo, but if that were true, it would be very interesting. And I asked AI, what would be signs of the LBMA breaking? The first thing it said was widening divergence between paper and physical gold prices in indicating delivery stress. Well, it was at $82 an ounce difference. I don't know what it is now, maybe 30, 35, where, in other words, you can buy a contract in London and sell one in New York and get that arbitrage. Well, that's what a lot of people say that this is about. It's the arbitrage. And I don't believe that. I mean, yeah, it's enticing for a trader to do that, but the cost of shipping it across the globe kind of pulls the incentive away.
Andy discusses that many people see gold solely as an emergency or catastrophe hedge. Still, it's much more. It represents the private, portable wealth you can pass on to your children or access when needed. In today's rampant dollar devaluation and higher than reported inflation, with accurate rates possibly in the 11 to 12% range, gold offers a reliable store of value, immediate liquidity, and universal acceptance. While it's not the ideal asset for short-term goals like buying a house, where short-term treasuries might be safer, gold's consistent appreciation over time makes it an excellent vehicle for preserving purchasing power. You don't buy gold to get rich, you hold it because it's actual wealth, a safeguard against the insidious erosion of fiat money. Now let's recall the interview.
If you need to use, you're darn glad you have it. And too many people focus on gold as an emergency hedge, as a catastrophe hedge, as a sky is falling hedge. Sure, I mean, I guess you could say it does that too. But to me, it's wealth outside the system that is private, that I can give to my kids if I don't need to use it. And if I do need it, I'm darn glad I have it. And in an environment where not only are we lied to about inflation and money creation, as we're told it's 3 point whatever percent now, but John Williams would say put an 8 in front of that. And so you're at 11 or 12% inflation. So they lie about that. The dollar is continuously being devalued. And in a world of over-leveraged, undercapitalized banks, in a world of inflation and dollar debasement, that's what gold is. It's wealth, and it's there when you need it. It's immediately liquid, and it's universal. So I can't think of a better explanation of why to hold it. The only caveat I would say is that when someone calls me and says, look, I'm buying a house in 8 months, should I do this? I typically say no, because there's too many variables. I would say buy a 6 month treasury right through treasurydirect.gov and remove all of that risk. But if someone says, look, I have a lot extra money, I don't know what to do with it, I want to put it somewhere safe for the future, yeah, there is no better place to put it in my mind than an asset that is continuously, since 2000, it's averaged 9.9% per year. Compounding was up almost 30% last year. And so far this year, it's up 8 straight weeks in a row. There hasn't been a down week yet. Doesn't mean it will always do that. It just means that what gold is a vehicle to maintain your standard of living. And we can go back to, 30s with Roosevelt, go back to Roman times, and there's always those analogies, and they are true. You go back to the 70s, in 1971 with $35 gold, right when he closed the gold window, a 100-ounce, COMEX gold. Look at a 400-ounce gold bar from London in 1971 would have been $14,000, and today with gold at 2951, that bar is $1,180,400. Did gold go up, or did the dollar lose all of its value? And I say, in 1963, when my dad graduated college, he was making under $6,000 a year. And he said, your mother and I could live comfortably on that. Just the two of us. We were married then, he said. Well, how the hell does anyone live on $6,000 a year? Well, back then you could. Did the dollar, or did the cost of living go up, or did the dollar go down? I mean, so in essence, what this is insidious continual inflation eroding the value of the dollar. And gold finds a way somehow to maintain your standard of living, in some cases accentuate it. So you don't buy gold to become wealthy, you buy it because it is wealth. Better than holding it in a bank these days, that's for darn sure.
The current financial landscape, with aggressive tariff strategies, regulatory changes, and the widening gap between paper and physical precious metals, underscores the importance of gold and silver as enduring stores of value in an era of fiscal uncertainty and rampant dollar devaluation. As policymakers and investors contend with mounting debt, persistent inflation, and the potential unraveling of decades-old financial schemes, the shift toward tangible wealth becomes increasingly critical. How might a significant revaluation of gold and silver reshape investor confidence in the US dollar and broader financial markets? What policy measures could be implemented to address the fiscal gap without undermining the stability of national reserves? Share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.